Hello and welcome. Today we're going to be decoding a really crucial new provision in the Income Tax Act 2025. We're talking about Section 8. Now this section is a fundamental shift in how we tax capital assets when they're distributed during, say, a restructuring of a firm or an association of persons. So let's break down exactly what this means for you.
So let's kick things off with a scenario that every single tax professional has probably seen. Picture this. A partner decides to retire, but instead of getting a cash payout, the firm gives them a piece of property, maybe an office building. The question seems simple, right? But the answer, well, it's got some layers. Who's on the hook for the tax on that property's appreciation? Is it the partner who's leaving? Is it the firm itself? And here's the big one. Is the tax calculated on the old book value or its current market price? This is exactly the kind of situation this new law is designed to clear up.
And thankfully, the Income Tax Act 2025 gives us a very specific, totally unambiguous answer to that question. And you'll find it right there in the newly introduced Section 8. Honestly, this provision is critical for how we all need to think about structuring partner exits, dissolutions, and reorganizations from now on. Okay, so let's get into the nitty-gritty of this new rule. We're going to start by breaking down what Section 8 actually is, why it was even introduced, and the fundamental principle that it establishes. You know, the legislative intent here is crystal clear. For years, there was this kind of gray area. When a firm handed over an appreciated asset to a retiring partner, it was often argued that, hey, no transfer in the traditional sense happened, so no capital gains tax was payable by the firm. Well, Section 8 was introduced to plug that exact loophole. It's here to make sure that the appreciation in an asset's value gets taxed at the entity level right when it moves off the entity's books. And this right here is the bit of legal magic that makes it all work. Let's look at the actual language from Section 8, subsection 1. It says the specified entity, that's our firm, shall be deemed to have transferred the asset. That word deemed is everything. The law is basically creating a fictional sale, even if no money actually changes hands in the usual way. It's a brilliant example of just how powerful a legal deeming provision can be.
All right, let's really unpack the core mechanism here, this whole concept of a deemed transfer. You can think of it as the engine that drives Section 8. And if you can get your head around this, you'll understand the entire provision.
So, what in the world is a deemed transfer? Well, it's a legal concept where the law says an event is a sale, even if it doesn't look like one in a commercial sense. So when the firm distributes that property, Section 8 steps in and says, hold on a second, for tax purposes, we're going to treat this as if the firm just sold that property to the partner at its fair market price. And boom, that immediately creates a taxable event, and the liability for it falls squarely on the entity making the distribution, the firm.
The whole process really unfolds in 4 clear steps. First, you need a trigger event. Either the firm is dissolving or it's being reconstituted, which includes a partner retiring or a new one joining. Second, a specified person, our partner or member, receives a capital asset. Third, the second they receive it, Section 8 kicks in and creates this deemed transfer. And finally, step 4, this deemed transfer creates a tax liability for the entity itself. It's a really clear, logical chain of events. Now, theory is one thing, but let's see how this actually plays out with some numbers. We're going to take a simple, practical example to run through the calculation and see the real-world impact of Section 8.
Okay, here are the facts for our case. We've got a firm, ABC & Co. One of the partners, Mr. C, is retiring. As part of his settlement, he gets an office building from the firm. Now, this building was bought years ago, so it's on the books at a cost of 50 lakh rupees. But its current fair market value, or FMV, is a much heftier 2 crore rupees.
Now let's see how Section 8 forces us to do this calculation. As you can see, the sale consideration isn't the book value. No, it's deemed to be the fair market value on the date of the transfer, which is that 2 crore rupees. From that, we subtract the original cost of acquisition, which was 50 lakhs. And that leaves us with a capital gain of 1.5 crore rupees, which is now taxable in the hands of the firm ABC & Co. So, the most crucial point here is this. ABC & Co. is now liable for tax on a capital gain of 1.5 crore rupees. This liability pops up for the firm in the year Mr. C gets the building, even though no actual money was exchanged in a sale. This is the direct, tangible impact of Section 8 in action.
You know, understanding the law is only half the battle. The other half is making sure you're compliant and avoiding common mistakes. So let's shift gears and talk about the practical things that tax pros and business owners really need to watch out for.
To stay compliant, here's a quick checklist. First, and this is the most important one, get a proper, independent valuation report to establish the asset's fair market value. This is your foundation. Next, make sure you document absolutely everything in the retirement or dissolution deeds. Then, that capital gain we calculated has to be reported correctly in the firm's tax return for that year. And finally, don't forget this gain will attract advanced tax liability, which has to be paid on time.
And here are some big pitfalls to avoid. The most common mistake by far is using the book value instead of the fair market value. That's a direct violation and will get you into trouble. Another error is thinking the tax liability belongs to the partner getting the asset. Remember, the tax is on the firm. Bad documentation can also cause major headaches during an assessment. And finally, just being unaware of Section 8, especially when you're dealing with firms that own valuable real estate or other capital assets, well, that can be a very, very costly mistake.
All right, we've covered a lot of ground. So let's boil all of this down to the key takeaways you absolutely need to remember about Section 8.
If you remember just 4 things from this, make it these. 1. The taxable event is the distribution of an asset during a reconstitution or dissolution. 2. The person who pays the tax is the entity, the firm or AOP, not the individual getting the asset. 3. The value you use for the calculation is always the fair market value, not book value. And 4. The whole point of this section is to tax the unrealized appreciation of assets the moment they leave the entity's ownership.
And that brings us to a final thought. You see, the introduction of Section 8 isn't just a small compliance change. It's a huge strategic one. It forces all of us, CAs, lawyers, business advisors, to fundamentally rethink how we structure things like partner exits, family business settlements, and reorganizations. The old ways of doing things might now come with a pretty significant and maybe unexpected tax bill. So the question is, how will you adapt your advice in this new landscape?
Thank you so much for watching. If you found this breakdown helpful, please give this explainer a like, subscribe to our channel for more content just like this, and be sure to share it with your colleagues.
Just a quick reminder, this content is for educational purposes only and does not constitute professional advice. Tax laws are always subject to amendments, so please consult your professional advisor before taking any action. This is an AI-generated educational resource.